Hey everyone, welcome back to Corporate Decoder. Today we're diving into Oshkosh Corporation's latest report. And let's just say there are a few things that might make you go, that's interesting. Seems like they delivered some news on their Q2 earnings, and we're going to unpack what that really means for them. Before we get started, if you love digging into what's really happening behind the corporate jargon, make sure you hit that subscribe button. And hey, we've built a fantastic community over on Discord to keep the conversation going about these filings, so come join us. The link is in the description below. Alright, let's talk Oshkosh. This is a company that makes a pretty wide range of vehicles and equipment, from fire trucks and military vehicles to access equipment like aerial work platforms. For a while now, one of their biggest stories has been the contract with the United States Postal Service for their next generation delivery vehicle, or NGV. This filing covers their earnings for the quarter that ended on June 30th, and it was released on August 1st. Now, the company announced they are holding a conference call to discuss these results, and they'll have the slides and an audio replay available on their website. They're also very clear that any forward-looking statements made today are only good as of this date. They aren't promising to update you until their next earnings call, if at all. This is a pretty standard disclaimer, but it's worth remembering. They're essentially saying that while they project certain outcomes, a lot of things can happen to change that. And speaking of things that can change, one of the first major points they bring up is that their markets are highly cyclical. This means their business goes up and down a lot depending on the economy and broader trends. For example, things like construction spending, how much rental companies are buying, and even government spending heavily influence their sales. If the economy slows down, people and companies tend to spend less on new equipment, and that hits Oshkosh directly. Now let's get to the big one, the USPS contract. They've got a massive asset on their books from costs they spent before they started full production, and most of that nearly billion-dollar chunk is tied to this postal vehicle program. They've received orders for over 51,000 vehicles so far. This is a pretty critical number. As of June, they estimate their costs on this NGDV program are actually higher than the profits they expect to make on the orders they already have. That's a shortfall of $180 million. This means that even if they build all the ordered vehicles, they're looking at a loss on those specific contracts based on current estimates. They lay out several risks here, like the USPS ordering fewer vehicles than expected, production taking longer or costing more, supply chain issues, higher warranty costs, or a different mix of electric versus gas vehicles than they planned, and a big one, the USPS can just cancel the contract for convenience. That would be a major blow. On top of that, they're facing significant headwinds from trade policies and tariffs. They estimate that tariffs alone could cost them up to $50 million in operating income in the year they're filing this in, primarily on imports from China and the EU. This uncertainty can disrupt supply chains, increase costs, and make their products more expensive for customers. And it's not just tariffs. The prices of raw materials like steel, aluminum, and copper are really volatile. If these prices go up and Oshkosh can't pass those costs onto their customers, it eats into their profits. They mention that if costs go down and they can't get their suppliers to lower prices too, they could end up at a competitive disadvantage. Speaking of suppliers, they're really leaning on them for everything from engines and chassis to batteries. If these suppliers can't deliver parts on time, or if they have quality issues, it can cause delays, increase manufacturing costs, or even put Oshkosh in a position where they can't get their products out the door. Labor is another concern. They need a skilled workforce, and if they can't find enough workers, or if labor costs go up unexpectedly, it could hurt their finances. This applies to their suppliers' workforces too. A substantial portion of their business is with government agencies, particularly the US Department of Defense. This comes with its own set of risks. For instance, government contracts often go to the lowest bidder, which can reduce their profit margins. They might also lose out on contracts altogether, like they did with the Joint Light Tactical Vehicle follow-on contract, which went to another company. The JLTV contract has wrapped up, and while they expect US sales to make up for it, there's no guarantee they can ramp up NGV production fast enough to fully compensate for the lost business and profit. Government contracts are also subject to annual budget processes. If the government doesn't pass its budget, things can get delayed or even cancelled, completely messing with production schedules and cash flow. And even when they do get contracts, they're often fixed price, meaning if their costs go up unexpectedly, their profits can shrink. Because they work with the government, their systems and processes, like how they manage their money and their purchasing, are constantly under review. If these audits find issues, it could lead to penalties, contract adjustments, or even being barred from future government work. Competition is fierce across the board. They mentioned that some competitors have deeper pockets and more resources, which can be a disadvantage. They also face pressure from international companies selling products at lower prices. A significant impact they've already faced is the end of their licensing deal with Caterpillar for telehandlers. This deal brought in $315 million in sales last year. They're struggling to replace that lost revenue with their own branded telehandlers, and this has already hurt their access segment sales. Oshkosh is also growing through acquisitions like buying Aerotech and AUSA Corp. But they caution that they might not achieve all the expected benefits from these deals. Things like integrating the new businesses, cultural differences, or unexpected costs can derail these plans. Innovation is key for them, and they spend a lot on research and development to create new and better products. But they warn that if their competitors release better products first, or if they don't keep up with changing customer demands, especially around things like electric vehicles, they could fall behind. With about 14% of their sales happening outside the US, currency fluctuations are a big deal. When they sell products in other countries, they get paid in local currencies. If those currencies get weaker compared to the US dollar, the money they bring back home is worth less. This can really impact their reported profits. For their long-term government contracts, they use a method called percentage of completion. This means they record revenue and costs as they go, but it relies heavily on very complex estimates of future costs. These estimates can change, and when they do, they have to make adjustments. They reported that these adjustments, called cumulative catch-up adjustments, actually hurt their operating income by $22 million in the first 6 months of this year. They also extend guarantees for customer debt, which is basically them saying they'll cover it if the customer can't. And they've got a lot of money owed to them, over $1 billion in receivables. If customers can't pay, or if the value of the equipment used as collateral drops, Oshkosh could end up losing more money than they've set aside for these potential losses. They also mentioned a concentration risk, with their 10 largest customers in the access segment making up 30% of their receivables. Remember those acquisitions we talked about? Well, after buying companies, Oshkosh records something called goodwill. This is basically the value of the company above its tangible assets. They have a lot of it, especially in their access segment. They have to test this goodwill periodically to see if its value has gone down. If it has, they have to write it down, which is a direct hit to their profits. They did just that for their Pratt Miller unit, writing off $51 ex-Bexons dropped. Their debt agreements have rules or covenants that they have to follow. One is a leverage ratio, which basically means they can't take on too much debt compared to their earnings. If they fail to meet these covenants, it could cause some serious financial trouble. Taxes are always a factor. Changes in tax laws, especially with international tax efforts, could affect their bottom line, plus they're subject to audits by tax authorities, and any unexpected assessments could hurt their cash flow. Cybersecurity is a growing concern for everyone, and Oshkosh is no exception. They rely heavily on IT systems, and with increasingly sophisticated cyber attacks, there's always a risk of breaches that could disrupt operations, leak sensitive data, or even affect the products they sell. They've had some issues in the past, but so far, nothing that's crippled them. But the potential consequences of a major attack could be severe. Operating internationally also means they have to comply with things like the Foreign Corrupt Practices Act, which stops bribery of foreign officials. They also have to deal with export control regulations, and changes in the political or business climate in other countries could hurt their sales. Environmental regulations are also a growing area of focus. They might have to spend more money to reduce emissions, deal with climate change concerns, or comply with stricter environmental laws that could increase their operating costs. And that brings us to the end of the main body of the report, but they do list out their exhibits here. The most important one is Exhibit 99, which is that press release about their earnings that we've basically been dissecting. And then there's the interactive data file for the cover page, which is pretty standard for these filings. Finally, the report is signed by Matthew A. Field, who is their Executive Vice President and Chief Financial Officer. So what's my take on all this? Oshkosh is clearly a company operating in some pretty volatile sectors. The cyclical nature of their markets, combined with the massive uncertainty around the USPS contract not quite working out as planned financially, presents a significant challenge. They've got a big exposure there. On top of that, tariffs, supply chain issues, and fierce competition are all putting pressure on their business. The end of the Caterpillar telehandler deal is a clear hit they're still working to overcome. The $180 million to Navigated loss on existing USPS orders is a flashing red light. It suggests a fundamental miscalculation, or at least a very challenging path ahead for that program to become profitable. While they are diversified across different vehicle types, the scale of this one contract's potential downside is considerable. They're doing a lot of things right, investing in R&D and acquisitions. But the current economic climate and specific contract issues mean they have a lot of headwinds to push through. The risk factors they lay out are extensive and highlight a company needing to navigate a complex and sometimes unforgiving industrial landscape. They need to manage these risks very carefully, especially that USPS contract, to ensure they can maintain profitability and avoid further financial setbacks. Alright, that's our breakdown of Oshkosh Corporation's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.